Hi everyone, it's Steve Boyce and Nick Menegola from Capital Partners, and we're just here talking about market timing and the pros and the cons, the dangers, the risks, and why at Capital Partners we believe that to get a quality long-term investment outcome, you really shouldn't be too worried about trying to time the ups and the downs of the markets. So Nick, just a starting question, like how would you define market timing?
Yeah, so market timing is trying to make strategic decisions or tilts to your portfolio to try and take advantage of some short-term event. So that might be that you think a company is going to do really well for a short period of time, or it might do really poorly, and so you might buy or sell it depending on that. Another example might be if you think the world is going not quite so well and that the stock market might crash, you might sell your portfolio and go to cash. That's the most common one we hear.
Yeah.
And so it's just trying to take advantage of some short-term event that you think you can see coming.
Yeah, so do you see that a lot with your clients that you work with in terms of, because I definitely do, I see it with clients who, particularly newer ones, they'll come in and they'll be like, oh, really anxious about what's happening, you know, in the market. The ones we've heard about recently, obviously in the last few years, it's been COVID, there's been geopolitical issues. But what's been your experience in terms of like, you know, newer clients who have come in and how they've kind of reacted to this idea of, you know, trying to predict where markets are going based on negative news?
Yeah, sure. I think the first part is that it just feels so unnatural to build a portfolio, and then they've been so rewarded in their life by doing. They've worked hard to build their wealth, they've built their business or a career, and then they build a portfolio that is not set and forget, but it's built for all conditions. And so the response to not react to whatever's happening in the world just feels wrong. And so getting used to the fact that you build a portfolio that is ready for, we don't know what's coming, but we know something's coming. And so building a portfolio that's ready for that ahead of time and that you don't need to react is really foreign. But we get asked all the time, especially with new clients, and they want to know that they're making smart choices. And like I said, to make smart choices, they feel like they need to do.
Yeah.
What's been your experience with it?
Oh, like literally the same. I think it's particularly when we see new clients that come in, it's fascinating how many think that the role as an investor or as a financial advisor is to predict the ups and the downs, you know, get out at the top and buy in at the bottom. But there's just so much evidence, there's so much research, which just pretty much very, very clearly articulates like how difficult that is to do.
Yeah.
And this is not just for an average individual investor, this is also for like professional investors as well. So like fund managers who are managing, you know, billions or hundreds of billions of dollars. I think one of the really important things as an investor is you need to have humility. That the market is this fickle beast. It's virtually impossible to predict where it's going. And if you can have that humility and kind of release the ego, I think you get, you're much more likely to get a better outcome as an investor.
I like the Charlie Munger quote. It's amazing how much advantage I've gotten over my career from avoiding being stupid as distinct from trying to be remarkably brilliant. And so it's just avoiding those traps, because even if you get it right the first time, maybe by some miracle you get it right twice. If you then get it wrong a third time, then you've probably lost all of the benefit that you gained on the first two gambles. And so you have to consistently do it over and over and over again. And it's just the probabilities don't stack up.
I mean, that's the challenge. Without a shadow of a doubt, that's the hardest thing to do. So I've actually had a few family friends and people I've had a chat to over the years who literally try and run their own personal portfolios by kind of timing when to get in and out. And the hard thing to accept is like, you can get a call perfectly right. You can literally sell all of your shares at the top of the market. But then you have to consistently get those decisions right. So let's just say the market drops 10%. And the investor is thinking, I'm going to wait for it to fall 20% and then I'm going to get back in. If it drops 10% and then it rebounds back up again, all of a sudden, you can have made the best call in the world and got the sell right. But if you get that buy wrong, the market a year later could be trading at much higher levels and you're still sitting in cash and you've actually lost a lot of money. And as you were saying, like the hardest thing is just like to be a market timer, you need to consistently get it right. Which the research shows is virtually impossible. It's not about one or two decisions. It's literally like your entire strategy. You have to consistently be making the right decisions. People just can't do it. It's virtually impossible.
I think the recent Gaza conflict is a fantastic example of the perils of market timing. Like if someone at the start of 2023 divined there was going to be a war in the Middle East, what kind of investments would you make? You'd buy oil companies, or you'd buy oil futures, which is basically just a bet that the oil price is going to go up. In 2023, oil prices fell. Like you could have got your timing right and made really sound judgments, and this is with the benefit of hindsight, and you still would have been wrong, because it's just, A, we don't know what other forces are in play, and B, just getting the timing right, it's so difficult. And I think people find it particularly hard when their family and friends are the ones, and it's particularly when other successful people, so the one I always hear is, my doctor friend who's really smart and has millions of dollars invested is doing this. He's buying these lithium shares. And you go, okay, sure. You'll hear about the winners and when he gets it right, but you'll never hear about the countless times where he's potentially gotten it wrong, and the long-term return and long-term impact that's had on him. And sure, if you're a doctor and an anesthesiologist or something like that, and you can afford to lose a bit of money, then it's fine. But for people who need to get those decisions right and can't afford to take that risk, it's just not a viable strategy.
It's tough, yeah. I want to shift the conversation slightly to the media, to market gurus, people watching kind of the ABC, CNBC, Bloomberg, all these big financial media channels. What's your experience when people make decisions based on kind of what they read or see or hear in the media?
Yeah, sure. Well, it almost comes back to, like, is it going to work? Probably not. Like, these market gurus, if it was so good and they were so consistently right, they wouldn't be on the media promoting it. They'd be out investing it, doing it themselves, and consistently making all this money. But the challenge is that they're paid by viewership and not successfully accurately forecasting what's going to happen. No one pops up and is market guru, gotten this wrong 4 times. It just says market guru, PhD. And so they are tasked with making a compelling argument, not with being right. And so listening to them and responding to their recommendations, it's fraught with danger. It's kind of like going on a diet and leaving a donut on the counter every day. Like, you're just inviting temptation if you follow all that news, because you're going to hear really compelling arguments and it's going to make a lot of sense, and intuitively you're just going to be like, yes, this makes sense, I'm going to respond to this. But it doesn't work. Like, the data shows that 80% of active fund managers fail to beat the market over a 5, 10, 15-year period. And like you said, they're the ones with the big budgets, the big research teams, all the access to the data. And if they can't do it, what chance does a mum and dad investor at home watching the news?
Yeah.
What's your feelings on it?
I always find it fascinating. There's one which I always follow really closely, which is typically at the start of every calendar year.
Yeah.
You read through any, the Australian Financial Review, the West Australian, any big media organisation, publication, and you'll always have about 10 economists who are predicting where they think the share market is going to go over the next 12 months. And you'll typically have, 5 or 10 stockbrokers who are tipping, what are their best picks or specific stock picks for the next 12 months. And we've made a bit of a note over the years to kind of actually hold these people to account. So you see the, what they're all predicting in terms of where the markets are going, what's going to happen to interest rates, inflation, all those types of things. And then in December, you grab the paper out again, or, the publication, and you actually look at how many of them are correct. And the answer, as you'd probably expect, because no one can predict the future, is, virtually every single time the outcome is not what they think it's going to be, which is completely normal when you think about it, because every year there's always going to be events that occur throughout the year, things that happen, which, unless you have some magic crystal ball, you're not going to be able to predict. That's just the reality of it, which is going to influence where markets go and how things kind of track. But I think it's interesting news. But as an investor, you can't base an investment strategy on predicting a future which is unknowable and listening to people who think they can predict where things are going. So that's kind of my experience. And then, similar to you always hear the market gurus, who come out particularly on the TV, big financial TV channels. And there's just no accountability. No. So they're literally there to get eyeballs watching. So they say things that are sensationalist. They make all these big calls, but there's no one actually going back after 6 months to say, well, was that call right or wrong?
Yeah.
So you've just got to take a lot of that with a pinch of salt in terms of, it could be interesting, and you might kind of enjoy watching it, but you can't make investment decisions and build a reliable strategy that's going to work for you over the long term if that's how, if that's the framework for your decision-making process.
What would you say is more of a reliable strategy? And so if you're not watching the news, what would you do instead?
Yeah, so I think really important, like whenever I talk to anyone about investing, the starting point always needs to be, what's your framework and like how are you thinking about how those investments are going to work for your personal life. So really important to set goals. So like, what's the money for? Like really being clear about, what it is that the money's for, like how it's going to actually work for you, what it is you're seeking to achieve. Once you're clear on what you're seeking to achieve, you can actually then build an investment strategy that's aligned with your goals and what, your needs for liquidity, things you're seeking to achieve.
Can you expand a tiny bit more? Like, so say my goals are X, how might that impact my portfolio?
So for example, let's just take someone who's in retirement as an example. And let's say they want a passive income stream of $150,000 a year. So when you invest in shares or growth, what we call growth assets, so that's like Australian shares or international shares, what you'd reasonably expect is a more volatile investment outcome. So things will go up, things will go down, but over the long term, you'd expect a higher return than if you have money in cash.
Yeah.
So when you build a kind of a portfolio or a strategy, you need to make sure that yes, you have growth assets that are growing for the long term and that you're going to accept there's ups and downs, but you also need to kind of build a defensive component to the portfolio. So if the shares are in a, not doing so well, you've got other assets like bonds and like cash, which are available to actually, create that $150,000 income stream for you. So there's just lots of thinking that needs to be put into how you actually build a strategy that aligns to your goals, that's going to deliver the returns that you need to achieve the things that are important to you.
Yeah.
So just finding that balance.
So you're essentially matching the kind of the composition of growth and defensive to when I might need that money and how much risk I can how much volatility I can expose that portfolio to depending on when I need the money.
Yeah, definitely. Yeah. And we always talk about the risk trinity, which is how much risk is required, which is risk and return, which is required to achieve your goals. What's your capacity for risk? So how much risk can you afford to take? And also what's your tolerance for risk?
Yeah, sure.
So tolerance for risk is important because you don't want to be invested in lots of growth assets and have a really volatile journey as an investor if you can't actually handle that, handle that journey.
Yeah.
So just all of those characteristics are important to build a portfolio that's balanced, that's diversified, that's going to work for you, and that's going to deliver what you need to achieve your goals.
Yeah, sure.
Yeah. What about for yourself?
In terms of how do we...
so how do you build like a reliable investment strategy? Yeah,
sure. So the first thing, I think almost the starting point is, like you said, is always the goals and what's the money for. And then it's just about building what's a strategy that is really unlikely to fail? Because for clients that are coming in to see us, all of them have had some level of success in their life where they've grown their wealth through business or employment or a big career. And for us to implement a strategy that works 60-70% of the time isn't good enough. It needs to be 95 to 100% of the time the portfolio is going to deliver what you need it to deliver. So building a strategy that throughout history has done that is the starting point, and the obvious answer is diversification. Investing in, say, a market timing strategy is one example, or going hard on a particular asset class and investing a large proportion of your portfolio in one specific equity market or one specific stock is really dangerous because there's a lot of risk and variability. But when you spread that out across a lot of assets and essentially, instead of betting on one company, bet on the world to continue to grow, throughout history has worked 100% of the time over at least 5 to 10 years. And so it's just a really reliable way to build out portfolios. And so taking specific bets is not what we do. It's build reliable portfolios through diversification.
Yeah, 100%. There's one point you said there, which was the belief that markets are going to keep growing. I think that's so fundamental. Like for anyone who's an investor, being an optimist has absolutely served you better than being a pessimist. Because the reality is, if you look over over 100 years of investment data, yes, there's always going to be ups and downs in markets, but if you kind of have that long-term thinking, that long-term approach, without a shadow of a doubt, over every kind of rolling kind of 10 plus period of time, being an optimist has paid off. And people who are too pessimistic or too influenced by the negativity that's going on in the world and looking at everything that could go wrong rather than what could go right, typically end up with selling things down to cash and holding cash and getting that return rather than the 8 to 11% return that global markets have generally delivered annually, compounding every year over the long term.
And throughout all of those negative headlines that we've had happen in the last however many years you want to look, there's always something negative happening, but the markets continue to reliably deliver that 8 to 11% over the longer term. And so it's almost no matter what's in the headline, the right thing to do is to stick to your strategy and continue to believe that markets, if you give them enough time, they'll do what they need to do. And then even looking forward, like sometimes I think it is helpful to almost look at what are the positive trends that could really drive the market in the next few years. Some people might say it might be AI or green energy, and there's opportunities in that. Do you have any like kind of mega trends that you can see helping the market continue to grow?
Oh, good question. So I think the AI, the technology, is definitely the big one. So that's definitely been like a hot topic over the last 12 months. And what we have seen is a lot of the big technology companies are prospering or have done really well over that time period because of AI and tech. Green energy is the other big one. So we are kind of seeing a shift away from oil and gas towards green. And that's definitely kind of a big mega trend.
Population growth, potentially.
Population growth, that's a good one. Yeah. So I think the stats show that I think global population is going to grow to, I think that at the moment they're saying it's going to peak at about 9 or 10 billion people in the next kind of 40 or 50 years. So if you kind of get that, that growth in the population, then that's going to be more people who are consuming, who are going to need, goods and services, which is going to kind of, lead to kind of that continual growth. But there's lots of big trends. But I think the important thing is to understand that, just because there are big trends that are occurring, it doesn't necessarily mean that you have to shift your whole portfolio towards like, I've got to target these big trends. If you build diversified strategies, you're going to own all of those companies within your diversified strategy, and you own a lot of the smaller ones. So, owning small companies that, can potentially grow into larger companies is really important. And if you have that diversified strategy, you will own those smaller companies that have that potential upside as well. So it is a bit fraught with risk in terms of saying, we have these big themes of where we think the world's going, but to completely shift your portfolio to just target those things is a little bit dangerous. But interesting. And is there any I've missed?
I don't think so. No, I don't have any.
Quantum
computing.
Quantum computing, that one.
I feel like
interesting to research.
Almost falls under AI.
So I think just to summarise the conversations, really quickly to summarise the conversations that we've been having today. So from my perspective, the most important thing is not to start with the investments. It's to start with goals, strategy, building something that's really reliable. And then just having a long-term approach, not worrying about, the media or, market gurus to achieve those goals, and getting in and out at the right times. Just being kind of clear about what you're seeking to achieve. How would you kind of summarise the discussions today?
100% agree. The only things I'd potentially add are that there's almost no downside to diversification. Sure, you might miss out on the absolute tops, but to build a portfolio that consistently works, you diversify your portfolio, and that allows us to get really good outcomes consistently and for all the families we help work with.